The Walmart checkout line freezes at 9:47 a.m. on a Tuesday morning in Kansas City. The card reader blinks red. The cashier swipes again. Nothing. She tries another terminal. Same result. Behind her, 6 registers go dark and sequence like dominoes. The manager appears, confused, radio crackling with identical reports from every lane. Across the street, the gas station pumps shut down mid-fill. The ATM screen flickers to black. Inside the bank branch, a teller stares at her monitor as numbers begin refreshing in strange increments, currency values stuttering, then distorting. She picks up the phone. The line is already ringing. This is a simulation of what happens when the dollar loses its status as the world's reserve currency, not gradually, not through policy debate, but suddenly within 72 hours. We assume a triggering event large enough to fracture global confidence instantaneously. Historically, such ruptures do not announce themselves with warnings. They arrive as technical glitches, as numbers that stop making sense, as systems built on assumptions that no longer hold. The dollar has been the bedrock of international trade since 1944. Oil, wheat, microchips, debt, all priced and settled in dollars. Central banks hold dollars. Companies hoard dollars. When you buy something made overseas, someone, somewhere in the chain, converted currency into dollars to make it happen. This system works because everyone believes it works. Belief is the architecture. An architecture built on belief can collapse faster than concrete. In this scenario, the trigger is a coordinated announcement by 3 major creditor nations. China, Japan, and Saudi Arabia simultaneously declare they will no longer accept dollars for trade settlement. No military confrontation. No formal war. Just a joint statement released at 2 a.m. Eastern Time, timed to hit global markets before New York opens. The language is diplomatic. The effect is seismic. Within 90 minutes, currency traders in London begin selling dollars in volume. By the time Manhattan wakes up, the dollar has dropped 11% against a basket of currencies. Bloomberg terminals show red across every screen. CNBC interrupts programming. The phrase emergency measures appears in headlines, but the real story is not on television. It is unfolding in the payment rails, the hidden infrastructure that moves money between banks, processors, and merchants. These systems operate on a principle called correspondent banking. A store in Ohio processes a credit card payment. That payment travels through a processor, then a regional bank, then a larger bank, often converting between currencies or touching foreign institutions along the way. Every step assumes stable exchange rates and liquid dollar reserves. When the dollar begins fluctuating by the minute, those assumptions shatter. Algorithms detect volatility. Risk management protocols activate. Transactions queue, then they freeze. This is why the Walmart registers go dark, not because of panic, because of math. Payment processors cannot guarantee the value of a transaction that takes 4 seconds to authorize when the underlying currency is losing 2% of its value in that same window. So the system does what it is designed to do. It stops. By noon, 73% of electronic payment systems in the United States are operating in delayed or manual mode. Grocery stores switch to cash only. Gas stations shut down entirely because fuel distributors cannot price inventory that is simultaneously purchased in dollars, hedged in futures contracts, and valued against a collapsing currency. The price of a gallon of gas in Dallas changes 6 times between breakfast and lunch, not because of supply, because no one knows what a dollar is worth long enough to print a number on the pump. The second-order effects arrive faster than institutional planning anticipated. Hospitals begin canceling elective surgeries, not due to medical supply shortages yet, but because their billing systems cannot process insurance claims in a currency experiencing intraday devaluation. Insurance companies, which hold reserves in dollar-denominated bonds, watch those reserves lose value in real time. Actuarial models built over decades become obsolete in hours. In boardrooms, risk officers place calls to reinsurers. The reinsurers are not answering. They are on calls with their own creditors. Commercial real estate funds face redemption requests. Investors want out. But the funds hold properties valued in dollars, financed with dollar debt, leased to tenants paying dollar rents. When the dollar falls, the properties do not gain value. They lose liquidity. No one knows what to bid. Trading halts. Redemptions are suspended. Pension funds with exposure to these assets freeze withdrawals. A teacher in Oregon tries to access her retirement account online. The portal displays a maintenance message. It will display that message for 9 days. By the afternoon of day 1, currency markets are in free fall, but not in the way the public imagines. The dollar is not worthless. It is oscillating wildly. Against the euro, the yen, the yuan, commodities, even cryptocurrencies. Volatility itself becomes the crisis. Businesses cannot plan. Contracts cannot be honored. A shipping company in Singapore has a tanker midway across the Pacific carrying soybeans purchased in dollars, destined for a buyer in China who no longer accepts dollars. The cargo is in legal and financial limbo before it reaches port. Multiply this across 10,000 vessels, 5 million containers, countless transactions mid-flight. The global supply chain does not stop. It tangles. American exporters should theoretically benefit from a cheaper dollar, goods priced lower for foreign buyers. But exports require letters of credit, trade financing, and currency forwards, all instruments that depend on stable exchange rates and trustworthy banks. When foreign institutions stop honoring dollar-based credit lines, the machinery of trade seizes. A furniture manufacturer in North Carolina has orders from Germany. The German buyer's bank will not issue payment in dollars. The manufacturer cannot accept payment in euros because his suppliers, his workers, his debt all require dollars. The deal collapses. The orders are canceled. The workers are sent home. Stock markets open on day 2 in chaos. The New York Stock Exchange implements circuit breakers within 12 minutes. Trading halts. When it resumes, tech stocks paradoxically surge. Investors fleeing currency risk pour into equities, into anything that is not cash. But the rally is hollow. Companies cannot repatriate foreign earnings. Multinational corporations watch overseas revenue become untransferable. Apple has $200 billion in foreign cash reserves. That cash is now trapped in currencies that cannot easily convert back to dollars without triggering massive losses. The stock price spikes, then craters, then spikes again. No one is trading on fundamentals. They are trading on fear and momentum. Meanwhile, the bond market, the $80 trillion edifice that underpins everything, begins to fracture. U.S. Treasury bonds, long considered the safest asset on earth, are denominated in dollars. When the dollar collapses, those bonds do not become safe havens. They become anchors. Foreign holders, China, Japan, the UK, begin selling to cut losses. Yields spike. The government's cost of borrowing explodes overnight. A White House emergency meeting convenes. The Federal Reserve issues a statement pledging unlimited liquidity support. The statement is 17 words long. Markets ignore it. Credibility, once lost, cannot be restored with language. Local banks face a quiet run. Not a stampede, but a steady bleed. Customers withdraw cash, not because they think the banks will fail, but because they do not trust the value of their account balances. A number on a screen means nothing if that number is tied to a currency in flux. Tellers hand over 20s and hundreds, but the bills themselves feel abstract. What is a $20 bill worth if a gallon of milk costs $30 by tomorrow? People take the cash anyway. It is tangible. It is something. Credit unions in rural America fare slightly better. Their balance sheets are simpler, their exposure to international markets smaller, but they are not immune. They rely on correspondent banks for check clearing, wire transfers, and access to the Federal Reserve System. When those correspondent banks pull back, even the local credit union cannot process a simple wire. A farmer in Iowa tries to pay a supplier for seed. The payment is rejected. He drives to the bank in person. The branch manager apologizes. There's nothing she can do. The farmer leaves. He does not buy the seed. Next season's crop is already in jeopardy. Grocery stores begin rationing, not due to shortages yet, but due to uncertainty. Managers cannot restock shelves when distributors cannot price goods. A case of canned tomatoes purchased wholesale on Monday for $48 now costs $73 on Tuesday, not because of demand, but because the distributor's supplier is hedging currency risk by raising prices hourly. Stores limit purchases to 2 items per customer per category. Shelves thin? Not bare, just noticeably thinner. Customers notice. They buy more than they need. The feedback loop begins. Fuel becomes the critical bottleneck. Gas stations rely on daily deliveries from regional distributors. Distributors rely on refineries. Refineries purchase crude oil on international markets, priced in dollars. When the dollar collapses, crude prices in dollars spike, but refineries cannot pass costs to distributors fast enough because contracts were signed weeks ago at old prices. Refineries halt orders. Distributors ration fuel. Stations run dry, not everywhere, but enough. A trucker in Tennessee cannot fill his tank. He parks his rig. His delivery, 60,000 pounds of chicken bound for a processing plant in Georgia, sits at a truck stop. The processing plant, expecting that chicken, cannot fulfill orders to supermarkets. The supermarkets adjust their meat inventory. Shoppers find empty coolers. The chain is breaking one link at a time. Emergency services strain. Ambulances still run, but fuel allocations are tightened. Police departments extend shift lengths to reduce vehicle use. Firehouses delay non-critical inspections. Municipalities face budget crises as tax revenues, calculated in dollars, lose purchasing power faster than expenses can be cut. A city council in Michigan holds an emergency session. They vote to suspend road maintenance, delay payroll, and close libraries. The libraries were already struggling. Now they close. On day 3, the psychological shift completes. The initial confusion hardens into fear. News networks loop footage of empty gas stations, shuttered stores, and long lines at banks. Experts debate solutions. None of them agree. Some call for capital controls. Others demand emergency interest rate hikes. A few suggest a return to a gold standard. The The proposals contradict each other. The public stops listening to experts and starts listening to neighbors, to rumors, to anyone who sounds certain. Social media fills with barter networks. People trade canned goods for batteries, batteries for labor, labor for gasoline siphoned from lawnmowers. A suburban dad in Ohio offers to fix cars in exchange for firewood. The firewood comes from a tree his neighbor cut down illegally in a public park. No one reports it. The normal rules feel suspended. Corporations with offshore cash reserves and access to hard assets weather the storm better. Energy companies, mining firms, agricultural conglomerates, they own things that hold value regardless of currency. Tech companies with cloud infrastructure pivot to offering services in foreign currencies, bypassing the dollar entirely. But small businesses, restaurants, retail shops, contractors, they collapse. A bakery in Nashville closes after 40 years, not because people stop wanting bread, because the owner cannot pay for flour in a currency that might lose another 10% by evening. Pension funds and retirement accounts face catastrophic losses. The stock market's wild swings mean nothing to someone who needs to withdraw a fixed amount to live. A retiree in Florida watches his account balance gyrate between losses and gains that are meaningless because he cannot actually access the money. Withdrawal requests are delayed pending market stabilization. He calls the fund manager. The line is busy. It is always busy. Internationally, the consequences ripple outward. Developing nations that borrowed in dollars now face impossible debt burdens. A country in Southeast Asia owes $10 billion. The debt was manageable when their currency held steady against the dollar. Now their currency has strengthened relative to the collapsing dollar, but their revenues are domestic. Their debt is foreign. They cannot pay. Default becomes inevitable. The IMF convenes emergency meetings. There is talk of debt restructuring, of coordinated relief. But the mechanisms are slow. Bureaucracies do not move at the speed of collapse. Trade between nations begins shifting to alternative currencies, to bilateral agreements, to barter at the state level. India and Russia negotiate oil purchases in rupees and rubles. Brazil and China settle soybean contracts in yuan. The Europeans accelerate integration of digital euro payment systems. The world does not end. It reorganizes. And the United States, for the first time in 80 years, is not at the center. Domestically, regional disparities widen. Cities with diversified economies, with universities, with tech sectors, adapt faster. Rural areas dependent on agriculture and resource extraction face compounding crises. Fuel shortages hit hardest, where distances are greatest. A ranch in Montana cannot transport cattle to market because diesel is rationed. The cattle lose value. The rancher loses income. The bank that holds his mortgage loses patience. Some communities implement local currencies, script systems backed by municipal governments or local businesses. A town in Vermont prints its own notes, redeemable for goods and services within town limits. It works for a while because trust still exists between neighbors. But these systems are fragile. They rely on small networks, on reputation, on the assumption that tomorrow will resemble today. When that assumption breaks, the script becomes paper. Gun sales spike, not because of violence, but because of uncertainty. People buy insurance in the form of firearms. Ammunition becomes a secondary currency. A box of 9mm rounds trades for groceries, for car repairs, for peace of mind. Ranges run out of stock. Manufacturers cannot keep up. The shortage drives prices higher. A box that cost $20 now costs $80. People pay it. By the end of 72 hours, the systems have not collapsed entirely. They have bifurcated. There is an official economy, still operating on paper, on promises, on the hope that normalcy will return. And there is an emergent economy, operating on barter, on cash, on relationships and local trust. The two economies exist side by side, but they do not interact cleanly. A person can have money in a bank account and still be unable to buy food. Numbers and access are no longer the same thing. The government announces emergency measures, price controls on fuel and food, restrictions on currency exchanges, criminal penalties for hoarding. The measures are unenforceable. There are not enough regulators, not enough police, not enough compliance. A grocery store in Atlanta ignores the price controls and charges double for rice. Customers pay. They have no choice. The store is reported. An inspector arrives 3 weeks later. By then, the store has closed. Internationally, allies offer support. The European Union extends credit lines in euros. Japan offers yen-denominated bonds. But the offers come with conditions, with austerity measures, with sovereignty costs. Accepting the help means ceding influence. Rejecting it means isolation. The debates happen in closed rooms. The public learns through leaks and speculation. The wealthy, those with assets in foreign currencies, in real estate abroad, in gold, in art, they are largely insulated. Their wealth is portable, diversified, hidden in structures designed for exactly this scenario. The middle class, with savings in 401ks and home equity, they are devastated. The equity evaporates, the retirement funds freeze. Decades of accumulation become inaccessible or worthless. The working poor, already living paycheck to paycheck, find that the paychecks no longer cover the same expenses. Wages do not adjust fast enough. Rent comes due. Evictions begin. Historically, currencies do not collapse in isolation. They collapse because the systems built on them are already fragile. The dollar's decline in this simulation exposes fractures that were always present. The just-in-time supply chains, the over-leveraged financial institutions, the interdependence of global trade. These weaknesses are not caused by the collapse. They are revealed by it. Some regions stabilize faster. States with energy independence, with agricultural surpluses, with low debt, they adapt. Texas, with its own power grid and oil production, fares relatively well. California, despite its size, struggles with fuel imports and water infrastructure costs. The disparities create tension. Talk of secession resurfaces, not seriously, but the conversations happen. The federal government's authority feels distant, abstract. In the aftermath, the question is not whether the dollar recovers, but what recovery means. A currency can stabilize at a new, lower value. Life continues, but fundamentally altered. Imports become luxuries. Exports become lifelines. The standard of living adjusts downward for most, upward for a few. The global position of the United States shifts. Not gone, but diminished. Not irrelevant, but no longer indispensable. There are beneficiaries. Countries that position themselves outside the dollar system gain influence. China's yuan, the euro, even a basket of currencies managed by international agreement, these rise. Debt holders who shorted the dollar make fortunes. Defense contractors pivot to domestic production, insulated from import costs. Certain asset classes, farmland, water rights, energy infrastructure, they appreciate because they are real, because they produce, regardless of currency. But for the average person, the shift is visceral. The job that paid the bills no longer does. The savings that promised security are gone. The future that seemed predictable is now uncertain. Adaptation happens because it must. People learn new skills, form new networks, find new ways to survive. Humanity is resilient, but resilience does not mean painless. The 72 hours pass. The immediate crisis becomes the prolonged reality. The systems do not return to what they were. They evolve into something else, some better, some worse, all different. The screen fades, but the numbers keep moving. And somewhere, a card reader blinks red again. The cashier swipes. She waits. We all wait. If this left you thinking, there is more worth watching. Stay close.